Welcome to MasterMind Minutes, the podcast that focuses on the franchise industry. We'll cover topics that are important to franchisees as well as franchisors and share interesting insights that will help you build your business. We have one guest, we ask one question, and we do this in minutes, not hours. Good morning and welcome to another edition of MasterMind Minutes. My name is Gary Occhigrosso. I am the founder and managing partner for Franchise Growth Solutions and the publisher of FranchiseMoneymaker.com. For those of us joining, or for those of you rather that are joining us for the very first time, MasterMind Minutes is a very simple concept, very simple podcast. We have one guest, we have one topic, and we basically get one expert answer in a matter of minutes, not hours. We always say that we know that that's just a tease. So at the end of the program, we will give you the contact information for our guest, who is actually a returning guest today, Alicia Miller, and she is the founder and managing director of Emergent Growth Advisors, which is a boutique strategic advisory firm working at the intersection of franchising and private equity. And that's sort of our topic today. As a former multi-unit franchisee, she brings franchisees' perspective and operating experience to the engagement and really to the conversation. She's a recognized thought leader in the franchising industry. She has written a great book, which we'll also talk about. I'm going to fold it up here. I took the cover off, which I'll explain later, but that's it. Okay, big money in franchising. I take the cover off my books because I end up ripping them, and I don't want to do that. So I always take the cover off. Anyway, she also has a monthly column in Franchise Times. She's been published in Entrepreneur magazine and in Forbes. I believe you have published probably north of 70 articles at this point, all on this topic of franchising and private equity. So I'm very, very happy to have you back, and very thankful that you made the time to be with us today. How are you doing?
I'm glad to be here. Thanks, Gary. It's always nice to see you.
So before we get into the question and the book and everything else, tell us a little bit more about Emergent Growth Advisors and what you've been doing, and really where you are in the thick of it today in the franchising / private equity business.
Sure. Right now, my clients are getting ready for sale. They understand that the market's been a little bit slow recently. There have been some transactions, a couple of big ones that have made the news, but mostly buyers have kind of sat back a little bit and are being a lot more picky about what they want to acquire. So my clients are getting ready. They're expecting a very vibrant deal climate next year, and now's the time to get their house in order. So that's what they're working on.
Great. And that's always good to know. As I said before we started, you always seem to have some bit of information going on that most people don't. So with sort of that as the backdrop, why don't we just kind of delve into it? And again, the book, as I said, the book is, I'm holding it up, okay? It's big money, big money in franchising. And really, what we tell a lot of our clients who are mostly startups and emerging brands, generally speaking, nothing is forever. I don't know if that's a weird statement, but nothing is forever. So they may start their franchise company. They may be the franchisor because they think they want to build 10,000 units, create legacy, be the next Ray Kroc on the planet. And that's great. That's inspirational and motivational. I love it. But the truth is that when they get to 100 units, 150 units, maybe even a little younger, maybe even a little older, a couple of things happen. Maybe they get tired. Maybe they get too old. Maybe they run out of money. Maybe they realize if they really do want to have the 30,000 units and be the next Ray Kroc, they need some help. And that help generally is in two buckets. It's strategic partnerships for knowledge and strategic partnerships for money. So let's talk about the two of those, because what we always explain to our clients is, from the very beginning, even though you think you're never going to sell your company or you're never going to need capital infusion, there's a good chance you are and will. So what you need to do is practice some things in terms of being compliant and keeping your company buttoned up because when the private equity folks show up, they're going to want to see certain things. And if you make certain mistakes along the way, which we'll talk about, that's going to devalue, it's going to lower the enterprise value of your company, which you may not even think about today, but it might be 5 years from now or 10 years from now. So, Alicia, the question is, what are some of the traps, some of the things that you've seen emerging brands do or don't do that can mess up a deal 10 years from now?
Sure. Well, to start with, I think it's really important to assess whether you're franchisable. Not enough brands do the hard work up front or are too willing to be told what they want to hear, which is, oh, yes, your concept's brilliant. We've never seen a juicing concept like this before. We need to bring you to market immediately. The world needs this. And by the way, it's going to cost you, anywhere between $50,000 to $250,000 to get this franchise rolling. Well, if you haven't really assessed your readiness to be a franchise, you're probably spending money and not going to get the results you're looking for. You've got to take the time with some expert help up front to assess whether this is a good concept that is suitable to be a franchise. And then you've really got to look hard at your capital structure to make sure you can get it through the first few years. Far too many people start franchising with only one unit open, and it's just not enough cash flow to support the growth that you want to see. So, instead of spending that money on getting your FDD and your, legal structure set up, open another unit or two. That will give you much more cash flow to hire help, because then the first thing you're going to want to do is go sign new franchisees. Well, how are you going to support them if it's just you running your shop? I mean, I see it all the time. And that's probably the first big mistake people make. That mistake haunts you for years because you will be starving and you won't have enough staff. You won't be able to attract the caliber of talent you need to help you grow the thing.
Mm-hmm.
And franchisees might end up dissatisfied because they're not really getting much for their franchise dollars.
You're 100% right. I just want to sort of stop there for a minute and maybe unpack those a little bit, because the first one, the are you franchisable? By the way, little shameless self-promoting here. If you go to the frangrow.com, you can download our little 14-page pamphlet on are you franchisable, but it talks about a lot of questions you should be asking yourself if you want to franchise your business. We talk about a lot about whether the concept has proof, if there's proof of concept, have you validated? If you're running a restaurant, and this may seem like trivial, but it's not. Like, do you have great Yelp reviews? Do you have great Google reviews? Do people really love your concept, or do only you love your concept? That sort of understanding of your business being franchisable goes, again, I'll kind of stick to the restaurant business, but are the recipes duplicatable? Are the processes simple that investors can come in, maybe hire a general manager and actually duplicate and become multi-unit franchisees? That's definitely proof of concept. The second part about opening additional stores, we tell folks, if you're going to open an additional store, open it as the franchise prototype, because the first one may not be. The first one might be, you painted the walls and you got used equipment and you did whatever it is you did to get open. Well, if you're going to open another one, open it as if it's a franchise and view it like that, and train your team as if they're franchisees or the employees of franchisees. We also recommend, you want to be close enough to take care of it, but far enough away so that you may not have brand recognition, so you can prove out that you can launch that concept like from scratch. So I think those first two are key. What about things like when they are now franchising and, there's certain, documents, okay? I like, we see a lot of, very often, franchisors, they don't have copies of their franchisees' leases, or they're not named as and also insured on the insurance policy. Or talk to us a little bit about that and whether that disrupts or gives the private equity person a cause for concern.
So in emerging brands, remember, there's only a few PE investors and platforms that are willing to invest in truly small brands. So by small, I mean under 30 units open, because it's just a big lift, right? So most of them can't write checks that small, and the runway to get to be big enough to make it meaningful is too long. So there's just a small group that's willing to invest there. And they're not necessarily put off by you missing some of those things because they sort of expect it. You're an emerging brand. However, there's no reason to create that mess when just solid planning and a checklist up front will solve for part of that problem. So things like collecting the receipts from your franchisees. Well, you're no longer running your whatever your business was. Now you're a franchisor. You've got to act like it, and you've got to do some of this housekeeping to run the business correctly. And these checklists are out there. You can get it from my book. You can get it from my website. You can send me an email. There's any number of people that you can ask for this basic checklist of what you should have ready to go and you should be doing right from the beginning. Just try to start doing that. When you see the list, you'll say to yourself, oh gosh, this is a lot. Yeah, it is. But if you want to build a business that's attractive to the likes of private equity, you're playing with the big kids now, and you got to act like it. So
Right.
this is the stuff you've got to do. Otherwise, you will be seen as very small, and you just aren't going to attract the same types of investors, and you're not going to be able to scale either.
Yeah, and that makes perfectly good sense because yes, early on, as you said, maybe the investors, private equity or others may expect it if you're an emerging brand, but the challenge there is if that becomes sort of the way you do business or the habit that you get into, now
Yeah.
when you have 200 units, you don't have if you have 15 units and you don't have leases and leases are missing for 3 of them, or you don't have FDD receipts for 10 of them, that's a problem. But if you have 300 units and now you're missing 200, now it becomes a bigger mess to clean up. So I think what I'm hearing from you there is understand what those pieces are and practice them right from the beginning. And I think that's really the point. You mentioned in the book, and I think I told you I read these books, and I read your book again with a yellow highlighter. But there's an interesting piece here, looking at it from sort of the franchisor's side, where you talk about when considering potential capital partners, look at the firm's overall history as a sponsor of franchise businesses. What is their track record evaluating brands or operating groups and helping them achieve improved scale and performance? So that's an interesting statement there, because now the seller is evaluating the buyer, and you're saying that the buyer has to have track record not only of writing a check, but what can they prove in terms of what they've done to scale and improve operations of a company that they've purchased. Maybe you want to talk a little bit about that.
Sure. Well, when you're recruiting franchisees, you want ideally to know they can execute against your model. And you're looking for evidence of that somewhere in their career history, that they're going to follow your model and that they're going to be good at whatever they need to be good at to be an optimal franchisee in your system. You've got to ask those same questions of your private capital partner, especially if you're staying in the business and you will be working for them, right? If you're giving them, even if you're only selling minority equity, you still have this now partner underfoot, and you are going to be working together. So you better like working with them. And they need to have a track record. Track record matters. There's a lot of investors in franchising, and there's a lot of money sloshing around. But if your objectives are clear and you know what you want, you've got to find someone who can actually deliver against that. That second exit track record is important. And you've got to dig there, because a lot of investors have gotten kind of lucky. They've ridden inflation in valuation up, and that has resulted in a significant lift in value of the business. But that's not because necessarily margin improved or franchisee outcomes improved. So if those are important to you, you've got to dig and look specifically for those things. They're out there. There's some great investors out there. Just dig a little bit and find out what their track record is.
Yeah, great advice. So maybe there's no from a power point of view, and maybe this is a strange question, but In the transaction itself or in the engagement, does anyone typically have the upper hand? Like, who has more power in the relationship? Is it the franchisee? Is it the private equity sponsor? Like, you see any of that?
Well, franchise agreements are one-sided by definition.
Mhm.
And you need, when you get around to negotiating a deal, you definitely need help to make sure that you understand the contract you're signing. Some quite big deals have gotten done where the seller didn't really understand the creative structure that the PE firm put in front of them and were disappointed in the result of that. So you need help sorting through that.
Right. I think in the book you talk about um, investors can be patient, but don't confuse patience for being passive. That there needs to be a clear mandate, and that the franchisor, the seller in that case, needs to be open to that change. They need to go back in and perhaps rethink the unit level economics, rethink everything, because now the private equity firm is looking to scale it even at a greater rate as well as at a larger number. Do you find that private equity firms in general help franchisors grow faster and better, or maybe not so much better, just faster?
I think yes to both, faster and better generally. There have certainly been some instances where the outcomes were not very positive for the brand or for franchisees.
Mhm.
But private equity's gotten smarter over time and has really learned and embraced this franchise model, which works best when franchisees are profitable and satisfied with the investment. That doesn't mean they might not make changes that, not all changes franchisees are going to like for sure. But over time, if you watch the history of private equity across these brands, you see them mature, you see them get bigger and stronger. AUVs come up for franchisees, profitability improves. When you start to see a stall out, is either the market gets saturated and they have to get into new markets, or they change the model and the economics to the point where franchisees start to become less satisfied, then that's when a stall out happens.
Mhm, mhm. Um, so, and I guess if a brand is got traction and it's growing slowly, private equity comes in, they can help accelerate that. What about if a brand is struggling? Would private equity might they still have an interest in a struggling brand? Are they generally or ever interested in turning around a struggling brand? Do they see value there? What's been your experience with private equity in a struggling brand?
Most are not interested in turnarounds, especially small turnarounds, which is why you've got to be really smart as an emerging brand in the first place, because no one's going to, there's no one's coming to save you if you build the wrong thing. There are a few opportunistic investors who will, look for those kind of opportunities, but those are not traditional PE that are backed by pensions. Those are just opportunistic private investors, some independent sponsors, that sort of thing.
Right. So
Um,
those opportunistic investors can sometimes maybe just scavenge. They're scavengers perhaps, and they're just looking what pick something up real
Pick
cheap.
something up cheap, basically, yeah. But there's some of them that are specialists in turnarounds and specialists maybe in that sector where that can be very positive for that brand and a great reboot start for that company. So, for example, in the restaurant sector, there are a few of those that do quite well picking up these smaller brands and really streamlining supply chain, and they really understand that space very deeply, so they at least have a credible path forward to get that brand back on track. The ones who are independent sponsors looking to pick up a brand where they might not have any particular expertise in that sector, those are the ones I worry about. They may get it cheap, but man, cheap can still be expensive in the long run.
Right. Yeah, I have seen some of those. I have a term for that. I call it collect and neglect, where
Yeah.
the investor comes in, buys a struggling brand, does nothing really to help it. They're just sort of collecting, and it kind of runs its course, and they'll get their money back and then some, and whatever sort of happens. Okay, so enough of that doom and gloom stuff. On the other side, the book does talk about multiple arbitrage and about platforms. And I know they're just becoming so much more popular today. Can you talk a little bit about that? Maybe give a bit of an explanation and why that's so important in franchising today.
Sure. So multiple arbitrage basically is the process of adding value by buying and tucking in multiple acquisitions. So you buy, when you're buying one company, you might pay a single digit multiple or a low double digit multiple. But when you add 10 or 20 of them together, now your multiples in the low 20s or, mid 20s or higher. So you automatically get a lift based on that. But you also get a lift if you do a good job integrating those brands, sharing supply chain, sharing leads for customers, sharing franchise development leads. So you can really build a powerful platform. It works best in brands that are kind of thematically similar. So restaurants, home services, business services, child services, right?
Mhm.
And we've seen a ton of that. And private equity is really good at sort of bolt-on acquisitions. So they understand that very well. And you can build a nice fly machine if you're good at integrating those brands and actually benefiting from being part of a platform. It can be very powerful. If all you're doing is collecting them, that's different. Then you're really not getting any synergies with those acquisitions.
Right. And I think I mentioned to you, I have a client that has, well, they have more than four brands, but four of them are in a similar category.
Mhm.
And they really optimize their purchasing power. They optimize their real estate. There's so many, they optimize their equipment. They're really able to bring to the, put the franchisor aside for the moment. What we've learned in working with them and awarding franchises for them is that the franchisees benefit tremendously on better cost of goods, better equipment buying, better materials to actually build the unit that the private equity folks have brought to the table, so to speak, by having this multiple arbitrage, as you say, and having this shared infrastructure that benefits not just them, it benefits the franchisee. And of course, if it benefits the franchisee, it benefits the franchisor. That's sort of my take on it. You have a concept, and if you could just give, I'm just sort of switching gears here a little bit. You discuss a concept in the book that if you could just talk about a little bit more, I think the audience would love it, and maybe they'll be curious enough and they'll go out and get the book, which I recommend they do in any event. And that is, you have this term, this concept called the private equity or the PE profit ladder. What is that? I mean, I know what it is. I read about it, but maybe you want to talk about that.
Sure. So when I first started studying this, it became clear to me that this is not a whirlwind. It looks very confusing from the outside, but if you track what's happening to these brands, it's actually pretty linear. And even if they retrade several times, you can see the progression of these brands as they kind of move up. They get bigger, they get stronger, hopefully, and faster. And if things aren't done well, you can see them kind of fall off the ladder also in a very clear way. So
Mhm.
this PE profit ladder describes what happens to brands over time as they retrade between private equity owners, mostly, including, also family offices and other types, but mostly private equity. You start with an emerging brand specialist, and then you work on one that's really into accelerating growth, and then one that maybe is even bigger, but still accelerating growth. And eventually you end up sort of in a long hold investor, or you go public. But this progression is very clear. And I thought a ladder was an easy way for people to visualize it. And it turns out that it's kind of what's going on.
Yeah, yeah. And is there it? I guess for the long hold investor at the end, and maybe taken public, maybe the timing is different there. But for the emerging brand investor, the accelerator, sort of the mid market, are there? I don't want to say time limits, but is there generally a break point where they say, okay, now it's time to move this brand somewhere else? Is it based on time? Is it based on where they've taken the brand? Maybe both. What are some of the reasons an emerging investor would sell to an accelerator, an investor who's looking to accelerate?
Sure. Well, the first thing is they've got a mandate and they've got to monetize this investment, usually in about 6 years. That's the average. So
Mhm.
that puts them on a clock anyway. Also, you bring an emerging brand forward, and at some point you kind of run out of runway on what your contribution is going to be. You need new eyes and new skills on this now much bigger brand. And that's an awesome point to bring somebody else in, and they can take the brand forward from here. I think also, sellers are looking at the market, and markets run in cycles. So, even though the average hold time is 6 years, they might go faster or hold it longer just to try to optimize their exit, depending on what's going on in the market, right? So there's that market timing issue too.
Right, right. Well, okay. I have one more question for you, and then I want to get your final thoughts on things. But what do you see as the future of this sort of symbiotic relationship? And I call it that because back in the late 90s, I was with a company and we got into private equity, but I think I may have told you this story, but for the sake of the audience, it was too early on. Like private equity did not know what to do with us. Like they caught us, they paid us, and now what? And I'm not quite sure they understood the restaurant business. No, I am quite sure. They didn't understand the franchise restaurant business. Their goals maybe didn't match reality, but obviously that has changed over the years. So where do you see this going? It's almost as if almost everyone I speak with in the franchising industry is talking about private equity, private equity, private equity. And even as recently as 5 years ago, 8 years ago, you didn't have this conversation, and now it seems to be everywhere. What's the future?
Yeah. I may have over publicized this trend. I've been writing about it for years. I may have raised people's awareness to the point where it's sort of ridiculously in their face. But look, the space right now there's 400 new brands a year launching every year. So people are very attracted. They still want to launch a franchise business. PE has come in and put money into 700 brands. But out of 5,000 active brands, that's still a pretty small percentage. So
Yeah.
Most are still not attracting PE yet, but there's, lots of opportunity to do so if they do the right things. I think we're going to continue to see new funds coming in. They've figured out the franchise model is pretty terrific, and we'll continue to see new investors. But those new investors don't have a track record yet. So I think for franchisees and founders, both need to just keep their wits about them and evaluate potential partners very carefully to make sure that it's going to be a good fit and they can help them move the business forward.
Mm-hmm. Okay. And I agree. I agree. And yeah, I guess you are the catalyst for all of this. So if there's
I don't know that I wasn't the catalyst. I was definitely somebody who made it more prominent, but the trend was there, but I don't know what happened. Franchising, sort of this happened almost seemingly overnight, but not really, because it started in the 90s. But the whole franchise industry didn't even really think about this or talk about it much. And then all of a sudden, private equity was everywhere. Everywhere you
absolutely.
turned. So yeah, now we have to talk about it.
Yeah, and that's exactly what I was getting to. It's almost like I'm feeling this everywhere now where I go. So if there's any last thought, if I'm an emerging brand franchisor and maybe I have my eyes on saying, well, I'm going to build this thing up and maybe one day, exit into a private equity company or bring in private equity for strategic partnership, what sort of golden rule can you give me if there's I don't want to put you on the spot here, but
No, it's an easy golden rule. It actually hasn't changed. It's just the importance of it has intensified if what you want's a private equity exit. Every franchisee recruit matters a lot to your brand. Be so careful about who you're recruiting in, who is making those decisions, and that they have come in with the right expectations matched to the reality of what's going on in your business. It's great if you need to use outside sales. That's terrific. They can bring a lot of brands forward faster, if you don't have that expertise in-house. But you own the brand, and you're the one that's got to decide who the right franchisee is. Be really smart about that recruiting, because every franchisee is the validator. And, private equity looks at the business. They're going to look at the quality of the franchisees that you have and how effective they are in your brand. And so if you take shortcuts there, you're going to be sorry.
Yeah, great advice. And I can tell you, and what my company does. One of our divisions is we're an FSO, a franchise sales organization. But I think I mentioned this to you. I don't know where, maybe it was at IFA. I used the term that I often lose clients to the truth. And the truth is that it takes time, it takes patience, it takes capital, it takes care, it takes concern. It's not an overnight proposition. And I think, again, Clearly sort of the guidelines and the map and the education and the how to do it is right here in the book. See, Big Money in Franchising. And where can we, wait, your name is over here. Where can we get this?
Amazon.
On Amazon. Great. And if someone wants to reach you, what's the simplest way to do that, Alicia?
You can reach out to me at bigmoneyandfranchising.com. That's pretty easy to remember, or Emergent Growth Advisors, or find me on LinkedIn.
Great, great. Well, again, thank you for being here. Will you be in New York? No, you're not going to be in New York for IFE. I remember you told me you'll be here just after that, but maybe I'll see you at another conference. But thank you so much for joining us today. Again, we have to have you back on because there's so much more to talk about, and the industry now is so connected to private equity that I know that the last time you were on, I just had so many people contact me. They wanted to know more. That sort of warrants that you need to come back on at some point.
Be happy to.
Great. Thank you again.
Thanks, Gary.